Hi there, it's Laura, and I am going to be sharing a series of videos with some frequently asked questions in the mortgage process. So today's video, I wanted to talk a little bit about the different loan program options because that is a question that we get pretty frequently. Which program is best for me? So the first program that we have is our conventional program, and that is the traditional loan program that you've probably heard about, been around for a long time. So for us, a minimum down payment for a conventional loan is 3 to 5% down. And if you're able to do the 3% down, there's some extra rules and income guidelines, that sort of a thing. But kind of the minimum with that one is 5% down. If you do have a conventional loan, you do not have to have mortgage insurance if you're doing more than 20% down. So anytime someone has a down payment of 20% down or more, we really try to get them into a conventional loan to avoid that mortgage insurance. Conventional loans are stricter on things like credit score and debt to income ratio, so you really do have to have pretty good credit to be able to do a conventional loan. But the flip side of that, our appraisals on conventional loans don't have quite as many restrictions and things that they have to follow. So sometimes if a property is a little bit rougher, maybe more towards the fixer-upper side, we would tend to go conventional as far as that goes. The second program that people hear about pretty frequently is our FHA program, and that is a 3.5% down program. We do have some down payment assistance programs that we can talk about and offer, but again, some of those have income and credit score guidelines. FHA is a government-backed program, so a lot of the rules and fees and things like that are set by FHA. They do have mortgage insurance that's set by the program, so that is monthly, and it actually does stay on for the life of the loan. So if you're in an FHA loan, you're going to be paying that mortgage insurance until you either pay off the loan or refinance into a different loan type. They do also have an upfront fee that they roll in. Currently it's 1.75% of your loan amount, but that is rolled into your loan, so that's not extra cash that you have to bring at closing, but you do end up paying that over the life of the loan. FHA offers a lot more allowance for things like credit score, debt to income ratio, bankruptcies, foreclosures, that kind of a thing. Their guidelines are some of the most lenient as far as those things go. So if you have some bumps and bruises, that may be a better way to go. Sometimes we, depending on what your credit score is, if you're right on the bubble, we will kind of decide, are we going to do conventional, or are we going to do FHA, which gets you a better monthly payment. Here in our area, in the Muncie area, we also do a lot of USDA loans. So USDA is, again, a government-backed program by the USDA. It is a 0% down program. You do have to get final approval for this loan from USDA, so we have to kind of work through all of their rules and guidelines and things. They also have an upfront fee that's rolled into the loan. Currently, it's 1%. Your debt to income ratio does have to be a little bit lower for this program. It depends on credit score. They do take a little bit lower credit score than conventional, but you do have some other guidelines as far as that goes. This program is also income based, but it's based on the number of people living in your household. So if it's you and 2 children, your household would be 3. So there's different guidelines based on that. We also have to verify any income for any person that's in the household, even if they are not on the loan. So if you have a spouse that's not on the loan, we have to verify their income as well. It's also geographically based. So certain parts of, downtown in our city of Muncie is not USDA eligible, but parts of the county are. Other counties, the whole entire county is USDA eligible. So we can search that property and look up for you if that would be USDA eligible. They also, along with FHA, have some safety standards that they have to meet for appraisals. So that includes things like peeling paint because of the prevalence of lead-based paint in older homes. So any peeling or missing paint has to be taken care of before closing. Handrails, other safety issues, they do have to get into the crawl space in the attic, so those things have to be accessible. So sometimes we run into questions or taking a little bit extra time with appraisals on both FHA and USDA. The final loan program that we have is our VA loan program, and that is for military veterans. Also, some members of the reserves are eligible for that. So if you're not sure if you would meet that qualification, let me know and we can kind of research that for you. This is also a 0% down program, so no down payment required as far as that goes. It also does not have monthly mortgage insurance, which is a nice benefit for veterans. The VA loan does have an upfront fee, but it is based on your disability status with the military and any usage of a prior VA loan that you've had. So some people are completely exempt from the upfront fee, while others have, an upfront fee based on whether or not they've used their loan amount. VA is also very generous with credit scores and debt to income ratios, so that is an advantage if you've had some bumps and bruises and things on there. As far as appraisals go on a VA loan, they actually have their own complete set of appraisers, so we are a little bit sometimes waiting on the VA to get that assigned out and done, so we don't get any kind of say on who that gets assigned to with any of the appraisals, but VA we especially don't know until we get the appraisal back, and they also have those safety standards that the appraisals have to meet. So if you're not sure which loan program is right for you, I'm happy to talk that out. That's one of the first conversations I have with most of my customers. I'm available anytime. Please give me a call.